Welcome to Dad Gives Advice. My name is Orestes, and today I'll be talking about establishing credit and credit cards in general. So let's get right down to it. So we're talking about credit and credit cards, and there's just some basic terminology to learn here. One thing is the credit card companies, the companies that are actually providing you with a credit card are called issuers, and they're issuing debt. They're saying, we're going to provide you with a piece of plastic that will allow you to buy things on credit so that every month we'll send you a bill for what it is that you've bought, and you'll send us the cash to cover those purchases. And these issuers are also telling the merchants that are out there that are accepting the credit cards that they'll cover the payments. They're saying you're good for it. They're kind of the backstop, so that if you decide for whatever reason not to pay, which is a bad thing, and we'll talk about that in a minute. But if you decide that you're not going to pay for this, the credit card companies themselves are going to pay the merchants for whatever it is that you purchased. They're also going to provide you some protections, like if there's credit card fraud, if somebody steals your credit card number and goes off and tries to buy jewelry or something expensive with your card, the company is going to back you up on that. And basically all you have to do is call them and say, hey, somebody stole my card and it looks like there's some charges on here that are not mine. They will do an investigation. They'll make sure that it wasn't you that made those charges. And once they've established that, they'll then reverse the charges, and then you won't be responsible for that. They'll figure out how to take care of making the merchant whole, or do an investigation to find out who it was that made those fraudulent charges and get those stolen pieces of whatever it is, jewelry or whatever, back to the merchant. So there's kind of this give and take between you and the credit card company. Now, credit is I consider it a tool, and it's an important tool to have and to use in your life, and to be able to establish that as you get out into the real world, so to speak. Some of the folks that in your family or friends that you might have run across might tell you things like, oh, credit, it's bad, stay away, it's trouble, it's danger, I got into a lot of trouble with it and I don't touch it anymore, I pay cash for everything. And the reasons they're probably saying those things to you is because when they were younger and they started getting credit cards and establishing credit, they did it the wrong way. What probably happened is that they were making maybe $40,000 a year, and they went off and immediately got 10 or 12 credit cards and maxed them out. And then within a short amount of time, maybe they had a huge amount of debt, $50,000, $75,000 or more in debt. And now, when you're making a small amount of money and you have this huge amount of debt, now you're in a huge amount of trouble, because it's going to take you a long time, maybe forever, to pay off all of those bills. And so they'll give you the advice, stay away from cards. They're trouble because they got into trouble. But that doesn't necessarily have to be you. You can treat these things with respect and treat them a little bit more carefully and use them as the tools that they were intended to be. And that's what I'm offering, the advice that I'm offering here today. One of the main things, one of the big reasons why you want to have credit cards is, first of all, you need it to rent a car. If you're going to rent a car in the United States, most places will require a credit card. They will not just rent your car for cash. They want to have a credit card because they want to put a deposit amount on that card, so that if you wreck the car, they'll have some money to be able to pay for the damages if you waived your insurance or things of that nature. So they're also going to want to make sure that you have the funds to pay for that rental, and the credit card provides them with that assurance as well. It's also, if you have a credit card, they're also saying that you're a credit-worthy person and that you're worthy of renting a car to. If you're just somebody off the street that can't even have a credit card, they don't want to rent you a car, because they're going to think that if a credit card company isn't willing to give this guy a card or this gal a card, then I sure as heck am not going to give them a car that's worth $50,000, $60,000, $70,000 for them to go off the lot with and do whatever, who knows what with. So essentially you're going to need a credit card to rent a car. The other big reason, and probably more important reason, is you're going to need a credit card to establish your credit score. And the credit score, you probably have heard about that somewhere along the line. is important because you're going to need a good credit score in order to establish a pattern of you being a good credit risk. These credit scoring companies are going to want to look at your pattern of paying your debts and your income to determine how high a risk you are with respect to providing you with a loan. And that's going to be important when you go do a major purchase, like you're going to buy an appliance like a refrigerator or a big TV or something that costs, 4 figures or more. Or if you're going to buy a car, or if you're going to buy a home, you're going to want to have a good high credit score, because that's going to give you the lowest interest rate possible. And it's also going to get you that loan. If you don't have a high enough credit score, you might have to pay a higher interest rate, which means you're going to have to pay higher monthly payments for the thing that you're borrowing for. And so that's going to cost you a lot of money. And in the case of a car or a house, it can cost you an extra several thousands or tens of thousands of dollars over the span of the loan if your interest rate is a little bit higher than somebody else's because your credit score is too low. And if your credit card is low enough, if it's too low, you may not be able to get a loan at all, in which case you're stuck. You're not going to be able to buy a car or borrow to buy a car or borrow to buy a home. And that's not where we want to be. We want to be in a position to be able to do those things, and you do that by establishing a good high credit score. So the way this works is that you start working, you either graduate high school or college, you get a job, you start earning money, and when you get your first couple of paychecks, the credit card companies, they seem to be able to find you. Immediately, you'll see in the mail, you'll get credit card applications. They'll come to you. You don't even have to go to them. And that's when you have the ability to now look for a credit card to sign up for and start establishing your credit. You want to avoid getting multiple credit cards right away. You're going to get maybe a dozen or more applications in the mail. Pick out the one that has no annual fee, and if you can find one with no annual fee and cash back, even better. But get one with no annual fee and apply for one of those cards. If your parents already have a credit card, you might want to apply for one within that same bank or that same credit card company, because they are familiar with it and they can help you, kind of navigate their website and everything else. But look for a card with no annual fee, and if it has a cashback to boot, even better. You can apply either from the companies that have sent you invitations to apply, or you can go to your bank. Your own bank probably has a credit card division, like Bank of America and Wells Fargo, and all these folks have credit cards that they offer as well. Or you can go to the big banks like Citibank and other banks like that, Chase, that offer credit cards. So shop around for one with no fee and cash back, and you probably should be able to find that. Once you have this card, now you're having credit, you're able to use credit. Now the way to responsibly use credit is to make sure that you always buy only what you can afford for that given month. The way these things work is that every month you're going to get a bill. So let's say you start charging things on your credit card, and let's say in the first month you have charged up to $500 worth of things that you've bought on this particular card. The most important thing to remember is to try to make sure that you have enough money to cover those expenses for that month, so that every month you're completely paying off the credit card. It's possible, of course, and what the credit card companies want you to do is they want you to carry a balance. In other words, if you charge them $500 in January, then they're going to say, well, your minimum payment is going to be $25. You can just pay us $25 and you're good. You won't affect your credit score. Things will be just fine. And that means you're going to carry a balance of $475 to the next month. Okay. But what that means is if you only pay the minimum, or if you pay anything less than the total amount, whatever is left over, whatever is you're carrying over, they're going to charge you interest. And remember that on credit cards, interest is pretty high. It's a lot higher than like loans for cars or houses. Nowadays, loans for a house payment or for a mortgage might be 4 or 5%. Credit card interest rates might be 17, 20, 25% or higher, depending on the card. So they're banking on the fact that you're not going to pay this full amount, and you're going to carry this partial over to the next month, and they're going to be able to charge you interest on that. And it could be, like I said, 17, 20, 30%. Who knows? Right? It depends on the card. I don't focus too much on this part of it when I talk about credit cards to young people, because I stress that you should pay off the full amount. So when the bill comes in January, go ahead and pay off the full $500, and then this does not apply. There is no interest at that point. That's the key. Only buy what you can afford to completely pay off every month. Do not buy anything beyond your means. Don't treat these things like it's free money. A lot of people get into that bad habit of saying, I've got a credit card with a $5,000 limit. I can charge up to $5,000 and I'm good to go. No, well, you can, but then you're going to owe that $5,000 and you're going to be charged interest. And by the way, if you're paying minimum payments, like $25 to $100, depending on what your balance is, if you're paying minimum payments every month, it could take you years or decades to pay off the full amount. And at the end, if you'd owed, like, let's say you owed $5,000 to begin with, at the end you might end up paying $15,000, $20,000 or more, because you took the longest possible amount to pay it off, and that accrued so much interest that you doubled, tripled, or quadrupled what you owed to begin with. So I can't stress it enough. Pay them off completely every month, and that will do two things. It will avoid this extra interest charges and avoid you having to pay more for what it is that you bought. Like if you bought a kayak that was $200, let it be $200. Don't carry the balance, and then the next month you have to pay a little bit more for that kayak because you're paying interest on it, right? Don't do it that way. Avoid that whole mess, and always pay off your credit cards every month. I mentioned credit cards. You should start with one and focus just on one, and then after maybe six months to a year or a little bit longer, it's okay to get another one, and that helps you also build your credit score if you show that you can manage more than one card. But don't get any more than that. Just get one, like a Visa and then a MasterCard, so that if you go to a place that doesn't accept one, they can take the other. But focus primarily on the one card. That way you don't have to worry about juggling accounts and worrying about, did I pay this one? Did I pay that one? If you're always focused on just one, using one, and using the other one only for emergencies, like I said, nobody accepted the first one, then it's a lot easier to manage. And again, it also helps if you have a couple of accounts. It doesn't help if you have too many. If you have too many, your score is actually negatively affected. Your credit score is negatively affected. So again, this whole process is about establishing good credit, and getting a good credit score. So, I've mentioned that a few times. So what do I mean by that? So there are 3 major credit agencies in the United States, and they are the ones that track your income, your spending, and your debt, and how well you pay off your debt. If you're paying your credit cards and your home loan and your car loan monthly, on time, never skipping a payment, always paying the required amount, then they're going to say this is a good credit risk, and they're going to assign you with a good high credit score. If you're missing payments, if you're skipping months, if you're not paying the right amount, if you're being sloppy like that, they're going to ding you, and they're going to give you a lower and lower credit score. The agencies there's 3 of them that are the main ones in the United States. There are Transunion, Equifax, and Experian. And these companies focus on, like I said, tracking your credit and figuring out whether you're a good credit risk or a bad credit risk. And they assign scores. And the scores range depending on the company. If you have a score of greater than 700 to 750, then you're a good credit risk, and you're going to be able to do things like apply for loans and get the best interest rates, and you'll be approved for the most part for loans and credit cards and car loans and things of that nature. If you're in the low end, it's going to be harder for you. It's going to be, you might have to pay a higher interest rate, or you might not be able to get a loan at all. You might have heard some of these in the news, like Equifax has been, or Experian actually has been on TV a lot. talking about how they have an app and they're trying to be more consumer oriented or consumer focused, and you can do things like boost your credit score if you download their app because they want to track you even more than they already track you, and that might be worth a couple of points on your credit score if you want to do that. No harm to it, as far as I can tell. So these companies are tracking you to make sure that you're doing a good job paying off your debts in a timely manner. And what's happening is that once you've established credit and you've got these credit scores, then once you go, let's say, to a furniture store and you want to buy an expensive couch and you want to put it on credit, that company, whatever it is, whatever store they'll have a finance department. They will contact one of these agencies, and they'll check your score, and that's how it works, right? You'll fill out an application, and they'll say, "Hey, Experian," if that's who they work with, "tell me Mr. Johnson's score so I can figure out whether I want to give him a loan so he can buy his couch." They'll get the number back, and they'll either get a thumbs up or a thumbs down, and that's how it works. Anytime you go either to a car dealership, furniture store, appliance store, or go out to buy a home, you will have your credit score checked at one of these three or more, or maybe two of these three places, so that these folks that are providing credit have an easy way of determining whether or not you are a good credit risk, and that's how that works. I should mention that there are sometimes, when you go to, like I mentioned, a furniture store. When you go to a furniture store, sometimes they'll do things like they'll say, "Well, this couch costs you $2,000, but if you open a line of credit with us," in other words, you're getting like a little credit card with that store. And what they'll say is, if you open that line of credit with them, they'll give you no interest and sometimes even no payments for 18 to 24 months. 24 months. That's a great deal. That sounds like a good deal, and it is. And if you're offered this and you have good credit, you're able to establish this credit account with that store, you should take it, because it's essentially saying you don't have to pay anything on this for 24 months, and there's no interest for that amount of time. The catch is that don't wait until the 25th month to start paying, because if you wait until the 25th month, then they'll charge you all the interest for those 2 years, and that's what they're hoping that you'll do. So the way to take advantage of this and not have to pay more than the $2,000 that you're paying for the couch is split it up. Say, okay, I've got no payments for 24 months. I don't care what that says. I'm going to say divide the 2,000 into 24, and I'm going to send in payments anyway. So I'm going to send in equal payments over the 24 months at no interest, so that I can avoid that interest hit at the end of the 24 months. And like I said, this is a good deal, because if you use a regular credit card to pay for this $2,000, you'd have to pay it off fully within a month in order to avoid interest charges from the credit card. So in this case, you have a break. You don't have to pay it off at the end of the month. You can wait 24 months and pay it off, 1/24 every month until you're done with the payments. But again, do not wait until that 25th month to make even one payment. Make sure you've paid it all off within that no payment, no interest period, so you can avoid interest. Because even if you miss and you skip and you wait until the 25th month to pay one last payment, they'll charge you interest on the whole $2,000, because that's how they're hoping to make money off you on that credit account. So again, don't be afraid of credit cards. They're tools. Treat them with respect. Treat them carefully, and treat your credit like it's part of your character. Don't abuse it. Don't overextend yourself, and then you'll be able to establish this good credit levels and have that high credit, so that when it comes time to do other things you want to do in the future, like buy a house and buy a car, you can do so at the lowest cost possible, because you're going to get the lowest interest rate possible. The big thing to remember: the clients that get the lowest interest rates are the ones with the highest credit scores. So the higher the credit score you have, the better chance you are of having the lowest interest rate, which means that things that you pay for, things that you buy on loan, like a house or a car, will cost you less, and you'll be able to save a ton of money over the long haul if you're getting the lowest interest rate possible. To summarize, I want to give you the tips of how to maintain a high credit. And some of these things change from time to time, but generally speaking, these are the things to do in order to have high credit. And I've already talked about the first one, which is pay off your balances every month entirely. Don't carry a balance, and that will show the credit card companies that you're serious about paying off your debts, and on time, by the way, on time. That's very important. You pay your debts on time and you're serious about paying off your debts, so that's going to help you establish high credit score. Don't have too many debt accounts open at one time. So don't have too many credit cards, and too many home loans and too many car loans at the same time. Accounts at once. These are all things that should help keep your credit score high. Limit the number of times that you apply for credit in a given period. So limit number of applications. Don't go off and apply for 6 credit cards in a month, and then go to the furniture store and apply for credit at the furniture store at the same month or even the same quarter. If you just applied for a credit card, wait a couple months before you apply for credit at a furniture store, that kind of thing. Don't have too high of a balance. No high balance compared to your limit. You're going to have your credit card is going to have a limit of, say, $4,000. And you're not going to want to have your balance be too close to that, because that's a warning sign that your ratios are off, and the agency is going to ding you on that. So keep your balance, below, let's say, below 2,000, in order so that you don't have too high of a ratio there. Pay off those debts. Pay off debts, whatever they may be, whether they're credit card or car payments or what have you. Pay those off in time rather than shifting them to other debt instruments. In other words, try not to have the situation where you've got to move debt from one credit card to another, or from 3 credit cards to another, in order to be able to keep up with things. People get into a lot of trouble with that. So that's called debt consolidation. Try to avoid that at all possible, at all costs. So rather than consolidate. Don't close credit card accounts too often. Don't close too often, and that's because, again, that's kind of like a red flag in their system. If you're opening and closing too quickly, you look a little flaky, and you're not a good risk. And avoid late payments and defaults. Avoid late payments, and never default on a payment. Always pay. Goes back to always pay off and always pay on time. The other thing you should be aware of is that the U.S. government does provide, or does require, the credit agencies to provide you with a free credit report. So they have not just a credit score, but they also do something called a credit report, which is a more detailed report of your credit history. And you can get that for free. The government has passed a rule that says they have to provide it for free at least once per year. So you can go to a website called freecreditreport.com, and you can go there and enter your information and get that free credit report every year. I suggest you do that and look through it and make sure that there's nothing in there that is false information, an account that doesn't belong to you, or a report by one of the lenders or one of the agencies that says you missed a payment when you never did. If there's something in there that's incorrect, you can dispute that information with the agency, one of the 3 agencies that has that report that's incorrect, and they by law have to work with you to fix those issues if they are incorrect. And it only takes a couple of minutes to check that, but it's worth doing that every year so that you make sure there's no issues. The last thing I wanted to cover is that once you do have established credit with all these different agencies, They will have, of course, this credit report on you. You can get it at freecreditreport.com. But there's another thing that you should do, and I'll show you the Experian website for that. You should go to their websites, and I want to make sure that this fits in the screen here. And so let's go to Experian. And one of the things that you'll see, the first thing that you'll see in Experian here is their kind of sign up for their thing. They want you to sign up, but I just wanted to show you a freezing credit report. You go to this little menu over here on the right, and there's a credit support page. Now, each one of the different sites has a different location where this is, but you look for a menu like this somewhere that has this kind of information. These sites, by the way, also will sell you products. This identity theft protection is a product that they sell. You could sign up for it if you want and pay for that. That's fine. But the simple free way to protect your credit is to go into this credit support section and go into the security freeze section. And so, like I said, once you've established credit, make sure you go to all three of the agency's websites and do this process for freezing your account. You'll have to set up a free account with them online, typically. You give them your name and password and things you do normally with an online account. And then you go through their website to freeze your credit file. And what that does is when you go in and now you just go to the furniture store or go to the car dealer and they say, well, we have to check your credit, we have to run your credit in order for you to establish an account with us so that we can give you the car loan or give you the loan for the furniture. You will go back to Experian either on their app or on their website and unfreeze the credit so that they can do the check. So when your credit is frozen, nobody can open a credit account or a debt account under your name because you've frozen it and you've got the PIN and the password and all the secrets that you need in order to make sure that you're safe and your account is safe. What this does is it keeps fraudsters from going in and stealing your credit file and stealing your credit information. So what they do is if your credit is not frozen, they can go to a dealer, and if they have enough information on you, they can actually take out a loan based on your personal information. If they stole your ID or if they have a fake ID with your name and they have your social security number and a couple other things that are not that hard to get, they can go ahead and open the credit account. It's now a credit account that you're on the hook for, but they drove away with the car. So to avoid all of that, go to the three sites and go through the freezing process. And it only takes a few minutes, but it's well worth the avoidance of having to deal with fraud if somebody did steal your credit and opened up an account using your name and information. And again, once it's frozen, all you have to do is when you go to a place that you're trying to establish a new credit account with, all you'd have to do is unfreeze it so that they can do the credit check. Once they've done the credit check, refreeze it again immediately, and you're good to go. So anyway, I hope that was helpful. If you have any questions or comments, send me an email or send me a tweet, and have a great day.